and what comes out of that particular meeting. But let's talk about what our markets are doing and which direction are we headed right now. We have Aniruddha Naha, who is a CIO, Alternatives PGIM India AMC, joining us on the show. Very good afternoon to you, Aniruddha. Thank you so much for joining us on ET Now. And firstly, what's happening with the markets? What should one anticipate or prepare for, given the fact that we have seen a sharp bout of selling come in for the markets, a sharp correction where everyone is touting that this is just a bull market correction, SMIDs have been smoked. So what should one do? How should one strategize now going ahead?
So thank you for having me here. We've been reasonably conservative on earnings expectations since last June. I think we've changed our stance from being a bit conservative to more, optimistic on how things are going to look like. Purely because numbers this was the first quarter probably in the last 4 quarters where we started seeing earnings growth coming through and across market capitalization. So if I look at a few things, one is earnings growth clearly looking better than what it used to be. You've got the rate cuts already happening. There is enough liquidity which has been pushed into the system in India. Stocks have corrected 40 to 50%. The US yields seem to have peaked out in the near term. The dollar index has started correcting. I think the risk on trade should start any point of time. We would be reasonably positive, and I think for the next 1 quarter will be a great time to go ahead and build portfolios.
Hi Aniruddha, this is Ankita also joining in. Aniruddha, let's talk shop. We talk about the correction in Nifty. Well, despite after the correction in Nifty, the 12-month PE, forward PE for Nifty is now below 20 times. It's approximately 19.3 times, which is below its 5-year average. And if you look at the small and the mid caps, that's down anywhere between 18 to 20% from its highs. But despite that, there is still froth left. That's what the experts believe. Do you see further downside from here? Do you still believe there's froth in the SMIDs, and also therefore a good buying opportunity in the large caps given the correction that we are seeing?
Sure. I think the large caps definitely offer a lot of value out there, but if we have to slice and dice the mid cap segment also, which is probably the most expensive segment as we speak, if you take out about 5 or 10 of the stocks out there, probably 10 to 12 of that's what we did. The valuations actually come down to far more reasonable levels, and hence to brush all the mid caps or small and micro caps together as expensive is something where we will abstain from. We believe, especially in the small and micro cap segment, and to a certain extent in the cap also, it is a complete bottom up strategy. And hence, can someone go ahead and build a good constructive portfolio in those two segments also? I think so, that is absolutely possible. But clearly from a top-down perspective, when someone looks at just the indices, the Nifty or the large cap segment provides probably the best opportunities sitting out there.
Right, given the fact that we have seen a lot of them actually switch or get this sort of a call coming in that it's time to be in the safer place, and that would be the large caps if you compare it to the SMIDs. But let me ask you this question, Aniruddha. Given the fact that you had the budget play out, you had the RBI MPC meet outcome as well, and both of them actually gave a clear push towards these consumption sort of themes, more if you could call it as Consume India sort of a theme. Do you think now you are seeing that movement come out from Build India to Consume India? So basically not go in for the capex related counters, but instead go into the consumption related counter. Are you also of that camp?
Not exactly. I think so. What has happened is, yes, clearly it looks like there has been some incremental spending for the consumption side. There have been some, say, tax savings, etc. But please understand, last year around we were not able to match up. The spending was not able to match up to the budgeted expectations also. And what the government has done is just kept it at those levels. Even if we achieve what has been budgeted, it would still be about a 12 to 13% kind of growth over the last year, which is very, very good enough. Now, if you look at the investment cycle, investment part of the universe, I think so, we will have to decipher which are the segments which will probably benefit even from here. And in those segments, there would be companies which will stack out reasonably well. So I think our view on the market clearly is, be it large cap, mid cap or small cap, we cannot take any more sectoral calls. It has to be complete bottom up. And our view is also that probably in the next couple of years, good stock picking will outperform ETFs and passive funds by a big margin.
Right. Aniruddha, there is likely to be a diverse performance across sectors, caps, or even stocks, because the street will adjust, to its fair valuation multiple and, the earnings assumptions for the companies as well in this correction. So how should one strategize now, and what are pockets of value according to you in this scenario?
So again, just coming down to market capitalization wise, I think it's the large cap and the small and micro cap space. I think so that is where, so someone can play a barbell strategy, to probably reduce their exposure to the mid cap segment and play it across the other two ends of the market. But if you come to sectorally, I think the results very clearly indicate that within a sector also, there is a lot of disparity in terms of how earnings have played out. Let me put it this way, the earnings has actually surprised us positively this time around vis-a-vis what we were expecting, and that is something which augurs well for the markets. And the next quarter, which is the quarter which we are in, I think it is going to be a heavy earnings quarter, and hopefully things should play out there. But if we have to come to sectors, I think so the lending sector, especially the large or private sector banks, could look good. We like segments like smaller sectors like cement could probably stand out to be a good sector to be in. Even smaller sectors like the garments and textiles, that will be interesting. The investment cycle oriented, cap goods oriented stocks have corrected reasonably well. And if the earnings has not dipped off the way people thought so. So we would take contra bets on, capital goods and defense to build a portfolio for the next 2 to 3 years.
Goods and defense coming in as your contra bet, but you did say that you like the private sector banks. I want to put in the spot, Aniruddha, to ask you why not PSU banks? Given the fact the quarter gone by, all of them actually most of them posted really stellar set of numbers. Their performance also stood out when you compare it to the private sector banks. So why wouldn't you take that move towards the PSU banking names? Because most of them are actually making sure they're strengthening their balance sheet.
Sure. So let me correct myself. I think the large cap PSU banks, probably a couple of them, we like them. There is absolutely no doubt. And they have weathered themselves very well through a down cycle in the asset quality. I think what is going to happen is probably into the next 6-9 months, you are going to see the asset quality cycle start worsening over a period of time. At least in the next 6-9 months. And there will be the real test of, the smaller or the mid-sized PSU banks, how they augur or how they, face off against the asset quality. If they do that and through this cycle, that could probably be very interesting. Generally, we have seen in an asset quality cycle, the private sector banks, especially the large ones, I am not talking about the mid or small cap ones, the large ones stack out very well. And that is something, given where we are on the asset cycle, it cannot get better from here. It will probably worsen. And in such a scenario, I would want to stick to the large cap lenders across PSUs and private sectors.
Come back to you and just ask you one question on that asset quality part, where you said that there could be indications that going ahead a few months down the line, you may see some sort of an asset quality trouble creep in. Are there indications pointing towards that already? As in, why would you say that? Just wanted to understand the rationale behind it.
So we are already actually facing this across MFIs, if you look at it. And the funding for a lot of these MFIs probably would be on the books of some of these banks, and there are pockets of pain generally that is there. And our sense is it will get reflected to a certain extent in some of these books. Today, it is these books are impeccable in terms of the asset quality. We are at probably the best part of the asset quality cycle, and it becomes very difficult to extrapolate better asset quality from here. And hence, if you start normalizing that itself, you will start seeing asset quality play out. The issues on asset quality start playing out into the next 6 to 9 months.
Right, then thank you so much for giving us that clarity, actually, Aniruddha, and thank you so much for sharing your views coming in the markets, given the fact that it is large caps where the safety lies at this point in time, and also talking about your contra bets as well as the picks that you like in the market right now. Thank you so much for joining us on the show and sharing your views. That was Aniruddha Naha of PGIM India AMC. Right now, as you can see it on your screen, market seeing some